What is going on, guys? Welcome to another video of dividend investing in those monthly dividends. Now this video, I'm sure you've already seen the title. We're going to go over top 5 dividends that pay monthly that are not individual stocks, but they are actually, funds that are well kept. Now a couple of these are closed-end funds and we'll go over that, but some of these are newer funds as well. I mean, they're not 10 years old. They're only a couple years old, or maybe a year old. But I don't think that should scare people away. I think you should just definitely diversify into a couple of other ones, and that's why I'm giving you 5 in this video.
I've been getting dirty money.
Hey guys, thank you for watching this video. Don't forget to hit that thumbs up and subscribe. I'm putting out at least one video a week, giving you guys absolutely free content that's gonna help you guys, whether it's long-term, short-term, just in finance and everything like that. So with that being said, let's jump back to the video to kind of go over everything. So the first one, obviously here, we're not going to go over this one first. I actually want to kind of go over a couple of others. So the one that I want to just get out of the way first is QYLD. Everybody knows this one if you've looked up monthly dividends. I think it's a great stock right now. It's been doing great. There's no problem with it whatsoever. But I'm not saying that this is my number one hold. I think that, again, like I've said in past videos, I am holding this stock for the monthly dividend, and I think that's what everybody else is going to do. But I want to see the longevity of it, so I'm okay with holding capital into it and holding that money in there in order to get a return, and not expecting a 12% return every year, not expecting a 10% return every year. If I can get that 6 to 7% return every year on capital, I'm going to be happy with this one, plus a little bit of growth. I'm not saying that this one's going to grow a lot. I think more people are really banking on this one just for the dividend, and that's okay. That's 100% okay, but we don't want to see it devalue. So we're going to go on ahead and get into the next one, because not a lot of people have seen this one from what I understand, and I had a lot of questions last time on this one and on this video. JEPI. So this is the JP Morgan Equity Premium Income Fund. Now this is an ETF, and if you bank with Chase or anything like that, they probably actually show you this one. This one's actually quite expensive in my mind. Now I'm going to show you and why I think it is expensive versus some others. So this one's $61. Now don't get me wrong, $61 is not an outrageous stock. Look at Apple and look at all those others. They're obviously higher, but we're not comparing apples to apples there. That's apples to oranges. JEPI's a great stock here. It's 33 cents pretty much every month, and you guys can see it goes up and down. It changes. This one's not that old as well. Again, this is JP Morgan's version of another income fund for people. Again, it says Premium Equity Income Fund in the title. I like this stock so far. I do own a few shares of this. I am not big into this one at all, just mainly because I'm not a big JP Morgan Chase fan. If you guys are, it probably works out fantastic for you, and you guys can do the basic math to break down everything, what it is versus, like a PTY or QYLD or other stocks. Me, I'm really looking for that compounding, and I do think that this is a good fund. I don't like that it's $61. I like that it pays 33 cents a month, but I don't like that it's $61 and that it's not been very consistent when we go through all these monthly paying positions. So I do like this one. I think this is good for a foundational portfolio to get some of that income coming in. I do like JEPI, and I do think it has a bright future, but when you look at its holdings, this was the big thing that I clicked on the wrong one, that I'm not huge on. You got some Google, you got Microsoft, so there is room for growth. Duke Energy, which I think is a great company. I have them in the Midwest. I've used Duke for years. Intuit, and then you got a bunch of other little companies and stuff like that. And you guys can see the breakdown of this. So it is well diversified. I do like that quite a bit. But this isn't my main holding. This would never be my main holding in my portfolio income, or when it comes down to my portfolio income. So we're going to go on here to UTG. We did a video on this one earlier this week. If you guys haven't watched it, I break it down a lot more. This is focused just on utilities. Now, this one has been around longer, and I think that's a big thing for me. I want to be able to see, like a couple of the others that we're getting ready to go into, they've been around for a little while and they have proven to pay dividends. And this is what I'm talking about, because when you go to JEPI, you see a list of 15 payments. Okay, and that's good. You know, you're over a year now, which is great. But when we go to a UTG or a couple of these others we're getting ready to go to, there's a lot longer of a list, and you can see that the dividend income has consistently went up, and that's a huge thing for me. And it's only $35.57. Now you're only getting 19 cents, but that's okay because you're only paying $35 per share. I understand that dividend yield might be a little less than some of the others, but utilities are great. Everybody needs water, everybody needs electricity, and they do hold some water companies, they hold electric companies. Next Era Energy, I believe, is one of them, one of their big holdings. There is some great things to do with this one. I'm big on this one. I've said it in the last video. I like this one a lot. Doesn't mean you have to like it a lot, but I do like this one a lot. Next one, NUSI, NUSI. Now, this is the Nationwide Risk Managed Income ETF, so another ETF. And again, the biggest problem with this one is, and I like this one, is it's only since 2019, and that was at the end of 2019 when it was incepted. It just hasn't been around long enough for me to like. But again, it's got good things to it. It's got some good holdings in it. Obviously, I think they're all going to, but it's by Nationwide. And I have no problem with Nationwide whatsoever. I think a lot of these companies are going to it. It's about $30 per share, $28 per share, and you're getting 18 cents. So you're right around that UTG spot, but you are getting more in income. Now, again, it's been consistently going up, which I've got no problem with. Of course, I want my income to continue to go up. But what I like about NUSI that a lot of people don't think about, and this is something that I think a lot more people should be looking at, is the downside risk. They have literally purposely, and if you look up NUSI and Nationwide for Professionals Risk Managed Income ETF, it's going to go over everything with you here, and I think this is pretty important. So it's going to go over, and basically, guys, they're using derivatives, or an easier word for it is they're using options in order to make more income off of the money you are already giving them. And basically, they're playing both sides of the options. You can do it on yourself. It's just you're going to take a lot more time, and they've got a lot more money to play with and things like that. And they use leverage. Don't let them think that they don't use leverage. All these funds are going to end up using leverage. The stock market seems to be built off of leverage lately, and they make good money for you. So I wouldn't complain about this one whatsoever. Your yield, it looks like your dividend rate is $2.13 for the past year, based off of this for the trailing 12-month dividend. Again, I like this one. I've got no problem with it. I do plan on keep adding to this one. Now, the last one, and again, there is no absolutely perfect stock, guys. Just so you know, there is no more apples right now where you can buy them at such a low thing. Now, the only problem that we have had with this fund, and I'm 100% transparent about it because I do love this fund. I like PIMCO. They've done great. But now they've had a drop here in the past couple of weeks, and there's a good reason for it. And I think that you're going to see this more often. Or you're going to see, we want to see how this reacts is a better way to put this. So you're looking at about an 8% dividend yield, $18.94. I've been buying it under $20 for quite a while. I was buying it in 17s. And your dividend this month was 11.9 cents. So really almost 12 cents, but it was 13 cents, and it's been 13 cents for as long as you can see here. And there is more, it looks like. But this is a great dividend income fund. I do like this one. And again, we've done the back test where people have seen this, and PTY is right there with SPY the whole time. It does absolutely wonders. And then your income, when you come and look at it, PTY is obviously going to be way higher than the S&P 500, and even it's better than UTG, which is why I like PTY so much. No, this is not a video on just PTY, but the number one concern we have with this one right now is that dividend income every month. Now, I do believe that if it doesn't go back up, you're going to end up seeing it stay around that 11 cents. And that's great. Now, the only thing I would really care about when you're looking at PTY, and this is why I like using this closed-end fund tracker is being able to go and look at it and see where the NAV price is compared to it. So you're going to see that this fund actually does trade at a premium. So the price of the stock is actually higher than what the net assets are worth. Now, is that a problem? Yes and no. So again, this has to do with your preference. So if you're okay with having that a little bit different, you're looking at about, right now you're looking at about a $2 something cents difference in the premium versus NAV. So if everything closed down, you would sell everything at about $14 and probably 50 cents, $14.25, and then they would give you all your money back. No problem, because that's all the assets that they had. But right now, I don't see PIMCO going down anywhere. I think it's trading at a great premium. It is down below 20. Anything below 20 has been great for this fund. Now, if we can get it to go back down even further, I will be buying up even more massive amounts than what I am now and what I can get a hold of for a decent price. Again, I do like this fund quite a bit. I don't bring it up for nothing. It's so hard to find funds that are this great compared to if you went and bought O Stock or O Realty, which I'm sure a ton of you have heard of. And there's absolutely no problem with that whatsoever. But remember, when you look at things like this and you want to go and you want to compare dividend yields and stuff like that and how fast is your income really going to grow in order to be able to retire off this, this is a 4.12% dividend growth yield. And it's really not making you anything. 23 cents for $70, I can buy 3 shares, 20, 40, 60. I can almost buy 4 shares of PTY and get double the income out of that same amount out of that same money that I would be putting into O Dividend. And that's why you don't see me buy O Realty stock. Do I think it's a great company and things like that, and they hold great assets in commercial real estate? Yes. But do I think it's for everybody? Absolutely not. So with that being said, thank you guys for watching this video, and I look forward to seeing you guys in the next one.